The global financial system is breaking. This is not a distant possibility or a matter of debate. It is a structural reality unfolding across multiple layers of capital, credit, and liquidity. Signs of stress are no longer isolated. They are visible in the behavior of institutions, in the contraction of interbank lending, and in the divergence between asset prices and underlying economic fundamentals. Market indicators, once relied upon as measures of stability, are now unreliable. Volumes in previously liquid markets are declining. Price discovery is distorted. Confidence, the foundational principle of modern finance, is being tested against the weight of structural imbalances that have accumulated over decades. This breakdown is not a temporary disruption caused by cyclical factors. It is the result of deeply embedded mechanisms interacting in ways that amplify stress. Credit expansion, leverage ratios, derivatives exposure, and liquidity management systems are all reaching points where the mechanics of financial operation create compounding effects rather than dissipating risk. Institutions are not failing individually because of mismanagement or isolated shocks. They are constrained by the architecture of the system itself, which transmits strain through interconnected networks. Each participant, whether a bank, fund, or clearinghouse, is acting within the parameters imposed by systemic structures. These structures enforce behaviors that simultaneously stabilize in normal conditions and amplify stress under strain. At the same time, markets reflect these imbalances in subtle but measurable ways. Spreads between lending and borrowing rates have widened. Short-term liquidity has become more expensive relative to long-term instruments. Collateral requirements are rising. Risk premia embedded in complex instruments now incorporate hidden systemic pressures rather than pure economic fundamentals. These shifts are not speculative interpretations. They are observable facts. They demonstrate that the system is operating under strain beyond ordinary fluctuation. The financial network, built for efficiency and continuous capital flow, is beginning to show the limits of its design. The consequences of this structural breakdown are not merely theoretical. When liquidity contracts and confidence falters, the transmission mechanisms of money and credit slow or reverse. Lending, investment, and commerce are affected simultaneously, producing cascading effects across the economy. The pressure does not accumulate evenly. Certain nodes within the system, large banks, clearinghouses, and highly leveraged institutions, experience stress first, and their responses propagate through the network. These reactions are mechanical, not discretionary, and they force adjustments throughout the system that accelerate instability. This is the essence of structural failure. It is inevitable once systemic thresholds are reached. Observers may notice volatility in markets or temporary disruptions in credit flow and interpret them as anomalies, but they are symptoms of deeper, persistent imbalances. The unfolding events are consistent with historical patterns where over-leverage, interconnected obligations, and reliance on confidence create points of systemic vulnerability. The system's failure is not dependent on external shocks. It is embedded in the operational rules and incentives that define modern finance. Recognizing this, the breakdown is not a matter of conjecture. It is already happening. The mechanics of the system dictate its trajectory. Markets, institutions, and capital flows are all responding to the same structural forces. The process is deliberate, continuous, and inescapable. The financial system is breaking, and its fracture is visible in the behavior of the structures themselves, independent of commentary, speculation, or short-term interpretation. Beneath public awareness, critical adjustments within the financial system are underway. These actions are not dramatic announcements, but methodical, technical shifts that fundamentally alter the flow of capital and the management of risk. Central banks, for example, are expanding balance sheets through asset purchases while simultaneously restricting credit availability in subtle ways. This dual approach is not contradictory, it is structural. The injection of liquidity into markets is offset by higher collateral requirements, tighter capital adequacy standards, and increased scrutiny on counterparty exposure. These hidden interventions are designed to stabilize the system in appearance, but impose constraints that are rarely visible outside institutional circles. Interbank lending, a core component of financial functioning, has begun to operate under increasingly stringent conditions. Settlement and clearing systems are demanding higher quality collateral for short-term loans. The apparent cost of borrowing is no longer just a function of interest rates or market risk. It reflects an overlay of regulatory and systemic risk management. These hidden pressures are compressing liquidity quietly but effectively. Funds that rely on overnight or short-term refinancing find themselves increasingly constrained, forcing them to restructure portfolios, reduce leverage, or unwind positions. This process occurs in real time but without public visibility, producing the impression of normal market function, while systemic stress quietly accumulates. Shadow banking networks and non-bank financial institutions are also engaged in discrete structural adjustments. These entities have expanded significantly over the last 2 decades and operate with opacity comparable to traditional banking. As regulatory scrutiny and internal risk management tighten, These entities reduce exposures and offload positions in complex derivatives or structured products. The reduction is not reactive speculation. It is a mechanical response to structural constraints. By shifting risk quietly, these institutions transmit pressure to the wider market. Liquidity is absorbed in concentrated areas first, and the effects ripple through interconnected networks of counterparties. The public sees occasional market volatility but rarely perceives the underlying systemic contraction. Meanwhile, regulatory frameworks enforce hidden pressures on behavior. Capital adequacy ratios, leverage limits, stress test results, and liquidity coverage requirements guide institutional decisions. These frameworks operate on a schedule and methodology that is invisible to most market participants. Yet they shape the allocation of credit, the valuation of collateral, and the willingness to engage in market making. When multiple institutions respond simultaneously to these constraints, a form of coordinated contraction emerges organically. There is no central directive. The system's design produces this behavior automatically. Another underreported action occurs in derivative and repo markets. Margin requirements are rising quietly in response to perceived risk and volatility. Positions are revalued and exposures recalculated. These adjustments are mechanical and immediate, yet they are seldom reported until they manifest as price movements or liquidity events. As margins increase, institutions are compelled to liquidate assets to maintain compliance. The cascading effect is structural, not speculative. It spreads through the network of obligations and contracts, concentrating stress in areas that appear marginal until they propagate into larger market disturbances. The cumulative effect of these hidden system actions is profound. Credit availability tightens, leverage becomes more costly, and liquidity transfers more slowly. Yet the public rarely observes these processes directly. They occur in technical layers, within clearinghouses, internal risk models, and regulatory compliance systems. The system is actively adjusting, not in response to panic or sentiment, but in alignment with its own mechanical and structural imperatives. These hidden processes create the conditions for further instability, setting the stage for stress to propagate rapidly through markets, institutions, and capital networks. What appears as quiet technical adjustments is, in fact, the invisible architecture of systemic pressure in motion. The current state of financial stress becomes clear when the system is examined mechanically. Modern finance is not merely a collection of institutions. It is an intricate network of processes, obligations, and incentives. At its core, the system relies on three structural mechanisms: leverage, maturity transformation, and confidence. Leverage allows institutions to magnify capital through borrowed funds. Maturity transformation permits banks to lend long-term while funding themselves with short-term liabilities. Confidence sustains this arrangement, as participants must trust that obligations will be honored, that liquidity will remain available, and that counterparties will perform. These mechanisms are efficient in ordinary conditions, but they are inherently fragile under stress. Leverage amplifies both profits and losses. Institutions extend loans or acquire assets far beyond the capital they hold. This creates interdependence. The failure of one node can transmit stress through multiple counterparties. Derivatives, structured products, and off-balance sheet exposures magnify this effect. The notional value of contracts often exceeds the actual capital backing them, creating systemic risk that is invisible until stress forces revaluation. When obligations are restructured, collateral is recalled, or positions are liquidated, the mechanical effect ripples across institutions in a predictable pattern. The system responds not through human deliberation, but through the pre-programmed rules of leverage, risk limits, and collateral requirements. Maturity transformation introduces additional systemic tension. Banks and financial intermediaries borrow short-term funds while extending long-term credit. This arrangement depends entirely on the continuous availability of refinancing. If short-term lenders withdraw, demand collateral, or increase rates, institutions must either reduce credit or liquidate long-term assets. Both actions create feedback loops that amplify stress. Credit contraction reduces economic activity, which in turn affects borrowers' ability to repay, triggering further systemic pressure. The tension between short-term funding and long-term obligations is an intrinsic design feature. It is not a temporary anomaly. It is the mechanism by which liquidity circulates and interest rates propagate through the system. Confidence is the invisible lubricant that enables both leverage and maturity transformation. Markets assume that counterparties will perform and that central authorities will intervene if necessary. When confidence falters, even minor disruptions in one sector propagate widely. Investors demand higher yields, banks tighten lending, and institutions adjust portfolios not for opportunity, but for compliance with internal and regulatory risk standards. The mechanical response to reduced confidence accelerates stress because actions are guided by systemic imperatives rather than discretionary judgment. Confidence operates as a force multiplier. Its presence maintains stability, its absence magnifies contraction. Interconnections further enforce these mechanical processes. Modern finance is highly networked. Banks, funds, insurers, and clearinghouses hold overlapping positions in bonds, derivatives, and other instruments. Obligations are cross-collateralized, exposure is bilateral, and risk is transferred across multiple channels simultaneously. Stress in one node triggers immediate recalibration in others. Revaluations, margin calls, and forced liquidity transfers are not random. They are dictated by the structural rules of exposure and risk management embedded within the system. The effect is cumulative and compounding. The system's design ensures that instability, when triggered, is self-reinforcing. Contraction in one area induces contraction in another. Liquidity, leverage, and confidence interact in a loop. Each response is mechanical, predictable, and dictated by structure rather than sentiment. Understanding these mechanics is essential to understanding systemic breakdown. Collapse is not the result of human error or unforeseeable events. It is the predictable consequence of interactions between leverage, maturity transformation, and confidence operating within a tightly interconnected financial network. The system functions according to its own rules, and when stress emerges, it behaves exactly as it is designed to behave. History demonstrates that financial systems operate according to repeatable structural patterns. Past crises illustrate how leverage, maturity transformation, and networked interconnections create systemic fragility. The current environment mirrors multiple historical precedents where seemingly isolated stresses propagated rapidly through complex financial architectures. Recognizing these echoes is not speculation. It is an analytical observation of structural recurrence. The collapse of the United States banking system in 1929 provides a foundational example. Banks had leveraged deposits to fund long-term loans and speculative investments. Confidence in the system eroded gradually, yet the first shocks were limited to individual institutions. As withdrawals increased and liquidity dried up, interbank networks transmitted stress rapidly. The failure of one bank affected others through shared obligations, creating a domino effect. Stock prices collapsed mechanically as margin calls and forced liquidations reverberated through the market. These structural dynamics amplified the initial shock, turning localized failures into a systemic crisis. The lessons are structural. When leverage is high, maturity transformation is extensive and interconnections are dense, stress propagates predictably and accelerates once thresholds are crossed. The 2008 global financial crisis provides a more contemporary parallel. Complex mortgage-backed securities and derivatives concealed the underlying fragility of the banking network. Institutions operated with high leverage and assumed continuous refinancing of short-term obligations. Confidence in counterparties was a critical stabilizer. When subprime loans began to default, the hidden linkages within derivatives, contracts, and off-balance sheet entities propagated stress rapidly across global institutions. Central banks and authorities intervened with unprecedented liquidity injections, yet the systemic pressure persisted because the architecture itself amplified mechanical reactions. Margin calls, collateral rehypothecation, and credit contraction spread stress far beyond the initial origin. Structural fragility, not temporary shock, dictated the outcome. Other historical examples reinforce the pattern. In the European sovereign debt crisis, interconnected banking and sovereign exposures created a feedback loop between government solvency concerns and banking stability. When investors reassessed risk, lending tightened, bond prices declined, and banks adjusted portfolios mechanically in response to regulatory and market pressures. Stress did not remain isolated. It cascaded through multiple layers, demonstrating that interconnection and leverage consistently transform localized risk into systemic impact. Even earlier episodes, such as the 1873 banking panic in Europe and the United States, show identical dynamics on a different scale. Overextension of credit, speculative investment, and dependence on continuous liquidity created systemic vulnerability. Initial failures, seemingly contained, propagated through the network of institutions, producing credit contraction and widespread economic disruption. The structural principles, leverage, maturity transformation, and network interdependence, were identical, even if the instruments differed. These historical parallels reveal a clear truth. Financial systems exhibit predictable responses to stress because of their design. Collapse is not arbitrary, it is a mechanical outcome of interacting structures. Each crisis differs in instruments and scale, but the underlying dynamics remain consistent. Leverage amplifies loss, maturity transformation creates liquidity tension, and interconnections propagate stress. Confidence accelerates or dampens the process, but its erosion triggers systemic effects. Observing these patterns across multiple centuries confirms that the current financial environment operates under the same principles. Structural fragility repeats. Understanding history is not theoretical. It provides a factual framework for recognizing systemic mechanics and anticipating inevitable consequences. The structural configuration of modern finance dictates consequences with near inevitability. When leverage is elevated, maturity transformation is extensive and network interconnections are dense. Systemic stress produces predictable effects. These consequences emerge from the mechanics of the system, rather than the intentions of individual participants. Each layer of financial architecture, banks, funds, derivatives markets, and clearinghouses, operates under rules that propagate pressure when thresholds are exceeded. The result is not chaos, it is mechanical cause and effect. The first consequence is contraction in credit availability. As institutions adjust to stress, lending standards tighten automatically. Banks and other intermediaries respond to rising risk by reducing exposure, increasing collateral requirements, and repricing credit to reflect structural uncertainty. This contraction is not discretionary. It is dictated by internal risk models, regulatory requirements, and liquidity pressures. The reduction in credit flows affects businesses that rely on short-term funding for operations and long-term funding for expansion. Economic activity slows because the circulation of money and credit is restricted. The systemic architecture ensures that contraction propagates beyond the initial nodes of stress, reaching sectors and participants not directly implicated in the originating event. The second consequence is asset price pressure. When institutions face increased collateral demands or margin calls, they are compelled to liquidate positions. Forced sales compress prices across multiple markets simultaneously. Liquidity becomes scarce, not because participants panic, but because structural mechanisms require adjustments to meet exposure limits and funding obligations. These adjustments cascade through interconnected networks. Bonds, equities, derivatives, and commodities experience mechanical revaluation. Market participants encounter volatility that reflects structural pressures rather than speculative sentiment. The propagation of price stress is inherent to the system's design, amplified by leverage and interconnection. The third consequence involves stress accumulation within institutions themselves. Balance sheets strain under simultaneous obligations, rising liabilities, declining asset values, and increased operational requirements. Liquidity buffers are depleted, forcing further contraction or asset sales. Institutions do not act independently. Their decisions are constrained by regulations, risk models, and counterparty demands. Each mechanical adjustment amplifies systemic tension. The networked nature of modern finance ensures that local stress generates global effects. Even entities that appear robust on the surface experience pressure through cross-holdings, derivative exposures, and collateral chains. Another structural consequence is the acceleration of feedback loops. Contraction in one area intensifies pressure elsewhere. Reduced lending slows economic activity, which increases default risk, which in turn reinforces lending contraction. Declining asset prices trigger additional margin requirements, prompting further sales. These feedback loops are mechanical and cumulative. They do not rely on perception or sentiment. They follow the system's internal rules. As pressure spreads, stress timelines compress, producing rapid system-wide adjustment. Finally, the consequences extend beyond finance into the broader economy. Capital formation slows, trade volumes decline, and employment and production are affected. Structural fragility ensures that these effects are transmitted through multiple channels. Economic cycles interact with financial mechanisms, reinforcing contraction and magnifying systemic pressure. These outcomes are inevitable, given the current design of interconnected, leveraged, and maturity-transformed financial networks. Structural consequences are unavoidable because they are dictated by the architecture of the system itself. Leverage, maturity mismatch, interconnection, and confidence interact to produce predictable effects. The contraction of credit, pressure on asset prices, institutional strain, feedback loop acceleration, and broader economic impact are not the result of speculation. They are mechanical outcomes of systemic design. Recognizing these effects clarifies the inevitability inherent in structural failure. The system enforces its own consequences, leaving little room for deviation from the path dictated by its internal mechanics. Pressure builds incrementally until it accelerates abruptly. Liquidity shortfalls, compressed timelines, credit freezes propagate faster than market participants anticipate. Margin calls, forced liquidations, and collateral revaluations amplify each other. Historical cycles show that contraction does not occur linearly. Once structural thresholds are crossed, reactions compound in rapid succession. The mechanics of interconnection ensure that localized stress becomes system-wide in a compressed time frame. Decisions that appear isolated are coordinated through invisible linkages, producing emergent acceleration. The system moves from tension to release with little warning. The horizon of stability contracts, and structural stress is experienced simultaneously across multiple channels. Systems operate according to their design, not intention. The financial architecture reflects accumulated incentives, leverage, and regulatory frameworks. Structural fragility is not moral, it is mechanical. History is instructive because it reveals the inevitability of these outcomes when design parameters interact under stress. Recognizing these patterns provides clarity. Instability is not random. It is the consequence of specific, observable interactions within complex systems. Understanding the mechanics, observing the hidden adjustments, and acknowledging the inevitability of cause and effect cycles allows a clear assessment of structural reality. Financial systems evolve, but their failures follow precise, repeatable patterns. Insight lies not in prediction, but in comprehension of these systemic truths.